There we go. Welcome, 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 everyone. It's my privilege to welcome everyone to FundRaise Conference 2022. We're really excited to have all of you here with us today. I think we have about 100 investors and entrepreneurs that are due to join us for this session. So really excited to be here with you guys once again for one of our founders events in 2022. Interesting times we find ourselves in, this kind of like post-pandemic world, not quite post-pandemic, this new bit of European war brewing, fascinating times at the moment around the world in terms of the venture landscape and where venture investment has gone over the last year or two. That's absolutely exploding. So I think it's a very interesting and exciting time to be here together for FundRaise Con this March. We are really stoked to host, I think, probably the best panel and bunch of speakers we've ever had for this conference. We have some venture builders and entrepreneurs from red hot startups, as well as established billion-dollar companies that are going to be speaking today. We have some legendary finance professionals and M&A leads and heads of finance who are going to be talking from their perspective. We have some amazing industry heavyweights that you guys have just seen, like Maxime and Tanya, who are going to be sharing their industry insights with us. And then we have some incredible investors here with us today. Some unicorn hunters like Hans Otterling and Kit van Zyl and Ian Lessem and Rob Hersoff, and a couple of guys who have invested in more companies that have become worth more than $1 billion than I can count on all of these fingers. So yeah, I think the last 2 years, the venture landscape has really changed. Borders have fallen away to a large extent, and venture investment around the world and on the continent here in Africa is at an all-time high. So it's a really, really interesting and exciting time to be alive and to be in the entrepreneurial landscape in South Africa, and as part of the global ecosystem. So yeah, we have I think there's loads to be gained here, regardless of what your background is, whether you are a finance professional joining us from that perspective, whether you're an entrepreneur looking to raise your next round of capital, tons of insights right here and excellent investors to meet up with. And if you're an investor, I think learning from peers and getting to see some of the amazing entrepreneurs and venture builders we've put together here, it should be very, very interesting and insightful today. So I want to invite you guys to just kind of sit back, relax, open that bottle of red wine, or if you're kid, maybe that bottle of champagne, and get ready for a really good lineup. We have 2.5 hours of packed content. It will be worth every single minute. So try to switch that phone off, open that bottle, have a good time, relax and focus. This will definitely count. And then maybe just before we jump in, these virtual events are amazing in that we can reach speakers from other parts of the world and we can have people join us from all over the world. That's really great, which is also why we've chosen this timeline for our American friends to be able to join in. Maybe just if you can and if you want to, introduce yourself. We've got a chat here that you can use. Just say, what's your name? What company do you represent? Are you a finance professional? Are you an investor, or are you an entrepreneur? And regardless of which one of those, what do you think the next ticket size of investment you're going to be working on will be? I'd love to hear that. Love for you guys to introduce yourselves. If you don't want to disclose your next $1 billion deal, you don't have to, but just introduce yourself and let us know you're here. We're excited to share this time with all of you guys. And then without too much further ado, then we can jump into the next session. Let me just have a look at this chat to see who we can say hi to. Jonathan, we see you. Thanks for being here. Lucille, great to have you hosting us. Thanks for that, man. Gideon Potgieter, great. 50 million Rand range. Exciting, man. It sounds like a great transaction. Who else have we got in there? Well, we give it a minute for you guys to just intro yourselves. Maybe some of the speakers would also be nice to hear from us. See, we've got some of our speakers online as well already. That's really great. Give it another minute or so. Go for it, guys. Now is your chance. Mr. Williams, great to have you. Welcome, welcome. Michael, great, man. Great to have some edtech companies here. We've just been Yeah, just been involved in an edtech deal with one of our clients recently. So it's an electric space, that edtech space. Absolutely great. See some African companies jumping on. Great, raising some dollars on the continent. Super exciting. Matt, one of our speakers, wonderful. Comparison has just raised a very interesting round that we may hear a little bit about later. And the next funding round is yet to be determined. We will keep a close eye out for that. Matt and team at Comparison. Great, guys. I'm gonna move us up and into the next session while you guys come in. Like, I'd really encourage you, if you feel up to it, just introduce yourself and your company, and yeah, maybe a bit about your next deal would be great to hear. And just tell me if you're an entrepreneur, an investor, or a finance professional. Great. We've got Robin from Focus Facilities joining us. Great. Good to have some entrepreneurs here. Matabu, great to have you. Okay. Let me quickly see, is Lazan and Tonya, are you guys online on my speaker panel yet?
So Tonya, welcome at our conference, and thank you very much for joining us. We really appreciate it.
It's my pleasure. It's always great to be here.
Super. Tonya, so you are the CEO of the South African Venture Capital and Private Equity Association. And I'm wondering if you mind giving us a little bit more background about your journey to joining SAFCA.
So I've been with SAFCA now for 5 years. It's unbelievable. Some people think it's 3. Some people have wiped out the last 2 years in their memory. But it's been 5 years. And my experience is actually not private equity and venture capital. I come from a human development, human behavior, leadership development, and business management background, and have been in a business school environment for most of my career, designing management and leadership solutions for big corporate clients, running academic programs and redesigning the MBA. So joined private equity and venture capital and just fell in love with the industry because of the positive impact it makes, and also the potential it has in terms of the investments they make and the difference that they can make to the economies and the societies that they invest in.
Super. So it doesn't sound as if it was potentially a very easy transition, but it sounds like a very rewarding one for you.
Not easy, but very rewarding.
I can imagine. Tonya, so South Africa's financial health is very important in what you do. And taking into consideration that we've just had another budget speech, can you give us some overview of your feelings towards the potential of investments in 2022?
Yeah, so a lot of times a big part of the role that SAFCA plays is to promote private equity and venture capital. But before we can do that, we actually have to promote Southern Africa as a viable investment destination. So a lot of the work that we do is looking at what makes Southern Africa and South Africa different. Why is it a good investment destination? What does it offer? So there's a lot of potential. I think the budget speech was a good one in terms of what the country needs. We need to look at our debt management, but then we also, what I like, and this also comes from SONA, is that the president and his cabinet understand the value of entrepreneurship, the value of the SME sector. And I think that they now realize that is where they can unlock future growth, and that's where the jobs are going to be created. So for the last 3-4 years, the president's hosted an investment conference, and it's always been eyes on the big businesses, making pledges, etc. But I think the reality now, and the government realizes that, is that small, medium enterprises is where jobs are going to be created.
Super. So that's very encouraging for our entrepreneurs.
Yes, definitely. There's still a lot of work to be done, but I think the penny's dropped.
Okay, brilliant. Sounds good. I guess my next question in a way feeds into that. Do you think there's anything to be excited about South Africa's economy over the next year?
I think we're on a good growth trajectory. I do think that there's a lot of potential. And what we've seen, what has actually happened with COVID, is that there's a lot of opportunities that entrepreneurs recognized and capitalized on. So digital disruption, changing consumer behavior has opened up the doors for new innovations, new businesses, and new revenue channels. So I do think our entrepreneurs are very savvy and they recognize these opportunities and took advantage of that. So there's definitely light at the end of the tunnel.
Great. Yeah, I think they're definitely brilliant at recognizing the opportunities and grabbing them with both hands. Great. So, Tanya, the country has just gone through a difficult pandemic, the country and the world. How do you think will the current invasion by Russia impact our ability to get back on our feet?
Yeah, it might set us back a bit. I think every time you think there's some headwind, something else happens and it forces us to be agile and adaptable. We might not feel the direct impact immediately, but I do suspect that some industries, some value chains and supply chains are going to be impacted. And it's going to be very similar to COVID, where there's some industries and some supply chains that are going to be constrained and they're going to find it difficult and they need to adapt. And it's on the reverse, it's also going to open up new opportunities again. So if Ukraine or Russia can't supply certain products or services to Europe or other parts of the world, they might open up opportunities for South Africa and Southern African entrepreneurs to do so.
So SAFCA is hosting a private equity conference in May, and your theme is fluidity. Which I think is brilliant, and I'm very excited to attend that. What do you think can entrepreneurs do to be more fluid and adaptable to external changes?
So our conference theme, as you say, is fluidity. And the reason why we chose that is the last 2 years, everyone's had to adapt and change, but we've had to do it with grace and elegance. So if you think of fluidity, it can either be fluidity in water, fluidity in movement, and even our conference streams, there's fluidity in our conference delegates choosing their conference experience. So I think if I translate that back to entrepreneurs and how entrepreneurs can be more fluid, it is about sensing, knowing what's going on in the outside environment, knowing which are those red flags that could have a potential impact on your business. So let's say it's COVID or it's a pandemic, whether it's COVID or another pandemic, whether it's war or some sort of political instability, just knowing which of those red flags could potentially have an impact on your business, your supply chains, your customers, and having plans to overcome those specific indices. And it really is about the basics of scenario planning, sensing what's going on in the outside environment, knowing which red flags or triggers might impact your business, your income, and then having potential plans to offset those potential risks and impacts. So it really is about looking at the bigger picture, but bringing it back home in terms of how can it impact your business in a short as well as a medium term.
I love that, especially that you mentioned the scenario planning, because I think that's probably something that small businesses specifically don't always focus on. They're surviving today or month end. Yeah, and I think with the events over the last few years, it's just shown that it's become more important to have those plans in place and not just be
exactly
active.
And I think a lot of times when you're in it, and I see it every day in our business as well, you're in it to survive, you're in it to make it work. You don't have the luxury to sit back and think about the world and how it impacts you, but you have to force yourself to reflect. So forcing yourself to reflect an hour a day or half a day, a month, just reflect on your business and think about the potential impacts on your business can add so much value along the line. But it feels like if you're not busy, you're wasting resources and time. But that thinking shouldn't be underestimated, and the power of reflection shouldn't be underestimated.
I love that comment about the reflection. Yeah, I think that's also something that we don't give ourselves the luxury always to do, but just stresses the importance of it. What you mentioned, what I also liked was the adaptability, but to do it with elegance. I think that probably added a whole different challenge to adapting to be able to do it with elegance, because it wasn't always easy, but yeah. Tanya, which industries do you think will the growth be in over the next 3 to 5 years? And do you think there will be any outliers of industries where investors are potentially not looking at all at the moment?
I think every investor wants that silver or that crystal ball so that they can guess which industry, so that they gear themselves up for investment. I think where everyone's focusing on now is health industries, education industries, really getting into the technology infrastructure, because we've seen the power of just having the infrastructure there to be able to remain productive. We've seen the power of fintech. That's been the fastest growing sector within the venture capital space that's received investments, is definitely the fintech sector. But I think we shouldn't underestimate the future of how and where and why we do things. So it's coming back to answer the questions: how do we do things? Where do we do it? Why do we do it? Just off the back of a meeting we had about VR technology and the fluidity between virtual world and reality, and how those two are going to come together much more closer in future. Let's take the education space as an example. When we used to learn about Egypt in school, you had to imagine it or go into an encyclopedia, which doesn't exist anymore, to look at pictures of Egypt. But with virtual reality, you can actually take children to Egypt back then to experience what that was like. So I think there's potential technologies in how we do things and why we do things that's going to be the industries of the future.
Right, thank you. Thanks for that, that detail. So what can entrepreneurs do under the current economic environment to prepare themselves for investment and incentives like the business bounce back scheme that was recently announced during the budget speech?
I think now's the time to really look at what are all the initiatives that are out there. There's a lot more ecosystem support for entrepreneurs, for SMEs, more so than I've experienced the last 5 years. So there's definitely more avenues and support at the moment, but also sort of the projects that I know of that's coming from various government institutions locally and internationally. We're going to see a lot more financial and non-financial support for SMEs. So in terms of gearing yourself up for that, really start with your financials. Make sure that's up to date. I think that's the most crucial part, is knowing exactly what's your runway, how much working capital do you have, what's your potential future growth, and where's your revenue going to come from, where's the risks within the business, knowing what could impact that potential revenue, etc. So the financials is very important. But on the flip side, it's also just being able to elegantly articulate what your business is and what problem you're solving. So a lot of times, we have entrepreneurs that are very technical, they're really good at what they do, but they're unable to articulate what it is that they do and whose problem they're solving. So I think it's important to marry those to the deep financial skills or readiness, together with just articulating what your business is and what it does and why it matters. So I think it's about just, balancing those two.
And I guess your last point also speaks again probably to reflection, or something that entrepreneurs can do in that reflective space, and maybe test those explanations on people who don't know their business, to be able to articulate it well. Yeah.
Yes, because you know your business inside out, but can you articulate it in a way that people that aren't in your industry understand it?
Yeah, exactly. So thanks a lot for your time, and thanks for sharing all your wealth of knowledge. I know that SAFCA's website also have a lot of information and resources for entrepreneurs they can refer to if they like.
Great, thank you. It was wonderful to be here, and enjoy the rest of the event.
Great, thank you very much.
Right, thanks to Tanya from SAFCA for joining us. Up next, we have probably the founding father of venture capital in South Africa, Keith van Zyl. Keith, so good to have you here with us today. So excited to hear what you have to say. we've asked Keith just to tell us a little bit about the evolution of the venture landscape that he's witnessed over the last basically decade or more spent in the industry. Keith, a privilege to have you here on stage with us, and thank you for sharing with everyone. Over to you.
Thanks, Lo, and yeah, well done, and congrats on all the good work you guys are doing to uplift SMEs and startups, and great conference, and good to talk to all of you. Yeah, Tanya added a couple of pearls of wisdom at the end there in terms of how to articulate the value proposition, etc. But yeah, just as a good sort of intro to the event, Knife Capital is a venture firm. I've been in the game with Eben van Neerden, my co-founder, and Andrea van Bomet joined us a bit later for 15 years. So, you know, started at my VC career at Mark Shuttleworth's EB Dragons Fund. That was in 2007. So really have a good sort of in the trenches view of how this space has evolved over the last 15 years. And building a business, as most of the entrepreneurs would know, is as hard as it has ever been. So nothing comes easy. However, the landscape is much more favorable when it comes to fundraising, access to capital, and ultimately capital is just a resource. It's a commodity. It shouldn't be that hard for entrepreneurs to just find that commodity and what they want. So if we go back to that period of between 2007, 8, 9, 10, there was basically only 3 VCs. It was EB Dragons, Mark Shuttleworth fund that we ran. It was Hasselplattner Ventures, which is Andrea, which is also part of Knife now, and there was Inventfin. Brett Kumail was at that stage part of Inventfin. He also branched out after that. 4DI Capital, which is still around, one of the top VCs, and came in. But deals were few and far between. It was really the top entrepreneurs. Many just had to bootstrap. There wasn't really much going on. There were other organizations that helped SMEs like Business Partners and a few others. So in 2010, the period sort of between 2010 and 2015, some VCs joined the fray. We really struggled to raise capital during that period. Had to get creative and launch things like our Grindstone Accelerator and a few other things. But yeah, it was still very difficult to get our hands on capital. And most of the transactions that happened at that point was still angel investment and angel investors doing their thing. So into 12J. So one can say what you want about the should it have been stopped and how the benefit, should it have only invested in majority in tourism assets and guest houses and hotels and so forth. But at the end of the day, a lot of money was raised mainly by companies like Kalon, Clive Butko and team, Knife KNA Ventures, which is Knife Capital's 12J offerings, and really has become much easier to at a point for us to get our hands on capital, but also introduce a whole lot of people to this asset class. I think that is the future of entrepreneurial finance, is more this intermediated approach where it is not big BC funds trying to kind of invest in a select few. It is just entrepreneurs investing in other entrepreneurs through platforms that take the friction out of the system. And this, I think, was a catalytic approach, because we now have 200, 300 investors and those are high net worth individuals that are actually also angel investors in their own right, and doing amazing things, and are not necessarily only do it because there was a tax break involved. So that is a good hangover from the 12J space. But yeah, to where we are today, across the continent, I think Max and Maxime Bayern's research took 7 weeks across Africa for entrepreneurs to raise $1 billion. Last year it took 21 weeks to do the same, and a mere 3 years ago it took almost a whole year for entrepreneurs to raise $1 billion on the continent. In South Africa, there is increased recognition of our entrepreneurial and specifically our tech entrepreneurial talent. There's many reasons for that. One of the the reasons is the SASME fund. So Ketso and Claudia and Thiru and Ryan and the team really have done an amazing job of just seeding and catalyzing an industry which is venture capital, and quickly became the biggest funder of VC in the country. So backed by 50 corporates, 1.3 billion rand, not a lot, but also is a lot, because at least one could more easily raise capital as a fund to say, well, at least I've got an anchor tenant, which is the SASME fund. They did a clever thing and really looked across the spectrum at some accelerators, some new funds, specifically female-led funds, Black-owned fund managers, and one or two of the stalwarts, the 40i capitals, the knife capitals of the world, Savant as an accelerator, etc. But so that is significant, because it really helps to put capital back into the entrepreneur's hands first, but secondly, because most South African entrepreneurs are generally B2B and not straight B2C, or at least B to small B2B business models, the funders, the Discovery Health and the Pick and Pays and the Capitechs behind the SASME fund makes it more easier to access those corporates. As I said, there's a little bit of a hangover from 12J still. Those funds still need to be deployed. We certainly have some cash left, as does Kalon, etc. Then the fact that international VCs are increasingly investing on the continent, that has had a good positive effect in terms of more international funders coming to the continent, but also to places like Cape Town, as one should, and trying to figure out how to get involved in the ecosystem. More angel investors are being created with every exit. So we certainly have a few of the entrepreneurs that we've backed through the years have exited with us, made quite a lot of money, and because they've got that entrepreneurial gene, as you all know, you're not very employable. You're going to try and make it easier for other entrepreneurs, or at least put your money where your mouth is to do so. So more and more angel investors, and as I mentioned, the space is becoming a little bit more open for anyone to really become a mentor, angel investor, etc. But just to remember the fundamentals of fundraising of the game, we always package it in find, make, grow, realize. Finding great entrepreneurs to invest in, finding the money as we have to invest in you. But that mainly the magic happens when three things collide. Thing one, awesome product or service. Business needs to be amazing. The innovation needs to be there. The scalability needs to be just 80-20, 20% on the top side, and not in the bottom quartile of a bad product. Secondly, a large addressable market for that product. No point in this fundraising game to play small. At least try and play big and swing for the fences. And thirdly, an entrepreneurial team that can execute. So if you have an amazing product service, an awesome team that can execute that awesome product into a large market, that's where the funding and the scale happens. Once you've found that deal, you need to make a good transaction. I think that's where the due diligences, the term sheets, safe agreements, all those things come into play. What is the value of the business? How do you close those transactions? What does your data room look like? I know certainly that Lo and team do quite a lot of work at that end. But then the hard work starts. Grow the business is market access, get clients, get all of that kind of stuff. And lastly, there needs to be a realization strategy. The more exits we can prove, the more legitimacy we can give this asset class, the more capital goes back to funders and founders. And yeah, we are very excited about that, because we look at entrepreneurs as our future bosses, as our future funders. And we need to make sure that we treat them with respect and not as this mighty funder coming to invest in entrepreneurs. So yeah, good luck, and thanks, Lo, for the platform. And yeah, I think it's an exciting space to be at the moment, and it's never been a better time to be in this ecosystem that we are in.
Yeah. Kit, thank you very much for sharing your wisdom with us. Find, make, grow, realize. We did Kit's course when we were in our infancy stages, kind of prior to first client, I think about 9 years ago already, where they had already kind of like set up this structure of thinking. And it's only taken the time to materialize this and to become one of the most respected venture capital funds out there. So that's really cool to see your journey as well as the development of the ecosystem. And I love what you said about just kind of like, founders starting companies, growing them, selling, and then starting to put money back into the ecosystem. We're seeing more and more of that at the moment, which really creates critical momentum that I think will take things forward. So yeah, thanks for the share. Great to have you here with us today, and keep up the good work on your end as well.
Thanks, man.
Brilliant. All right, Matt, are you with me? There we go.
I am. Hello.
Matt Kluis, great to have you.
Thank you very much. Excited to be at my first, I'm almost ashamed to say, FundRaise Con, but I'm a new kid on the block.
No, well, great to have you. All of the previous ones are on our YouTube channels. If you wanted to have a look at any of the great sessions from prior years, you're welcome to. But Matt, great to have you here today. Matt is the CFO and one of the co-founders of Comparisure, and they've just done a really exciting $1 million deal with some really big VCs recently. And we've asked Matt to just kind of, share that a little bit about that fundraising journey with us today. Matt, so over to you.
Super. Thanks very much, Lo. Again, really appreciate being here today and able to, share our 2 cents from the journey we've been on. I think Keith gave a really nice bird's eye overview of the landscape, from sort of 20 years of experience. My perspective is the opposite. It's the sort of worm's eye view from the trenches. So new entrepreneur on my first venture, 4 years in, but we've been through a couple of rounds of fundraising, and very keen to share with fellow entrepreneurs who are looking to do the first round, looking to get into this whole fundraising story. And I think as entrepreneurs, the one thing we all love doing is sharing and helping fellow entrepreneurs. So I really hope I can achieve some of that today. But I've tried to summarize our journey so far in a couple of slides. They told me at Varsity, keep your slides simple and keep your messages clear. So that's what you'll get today. But I really just wanted to dive into the fundraising journey. As Lo said, who, what, where, when, what does it look like? Try to shed a bit of light on the process from our perspective. So really just recapping our journey, and to fellow first-time entrepreneurs out there, I think the first person and people you got to fundraise from is from yourself. You have to raise money from your personal finances. That means getting your significant other involved. That's almost the first fundraising journey you go through. Do I have enough money to sort of bootstrap this project for a little while? That is scary, managing a personal runway and a business runway. So you need some iron nerves to get through that. But it really helps you obviously just build a business and evolve to a degree where you can do a proper round of funding. So our first 2 years were very much like that. But at the end of 2019, we were very lucky to get 40i Capital on board, our first investor there. And I think something to note is just that every deal is so unique. So the peculiarity of this deal is we signed a term sheet with 40i Access Trust and a third investor, an institutional investor. But during the process of drawing up legals and getting to the end of the deal, we as a business sort of went through a pivot that led to quite a portfolio conflict with the other investor in one of their companies. So we had to have some real discussions and debates around, does it make sense to have 2 similar companies in the same portfolio? But I think the openness, the honesty, and the transparency with which we all approached it really helped. But again, just sort of the peculiarities of each deal, and the fact that fundraising always takes longer than you think, especially when there's funny things that creep in. But an interesting outcome from that deal was that investors typically like to invest with other sort of institutions, co-investors. And that's what we were looking for, another sort of institutional partner. So we very quickly from that round went on to try and find another institutional partner, and we're very lucky to get Mkatu Wetu in partnership with Alan Gray on board. And then most recently, as Lo was saying, excited to have Havik lead our pre-series A and have 40i follow on. So I think that very, very, another important point is just, having guys that can back you from one round to the next. As a young entrepreneur, if you have guys that can do that, the signaling element of that is absolutely huge. So when you talk to investors, always good to know what their subsequent strategy for follow-ons are. Do they have some capital for subsequent rounds? That's a key point. But that's the journey we went on. And really, I'd just like to share a few lessons learned. Hopefully there's some golden nuggets in here. It's a very personal perspective from the journey that we've been through. So firstly, a question you might be asking yourselves: when should we start fundraising? When is the time to start? And this makes me think of Hofstadter's law. So Hofstadter's law is a self-referencing law, which is very interesting. Things always take longer than you expect, even when you take into account Hofstadter's law. So I think that very much sums up the fundraising process. It always takes longer than you think. It's very difficult to plan for that, so start early. Sort of a corollary that I've come up with is sort of the law of startup burn. Your cash always runs out quicker than you think, even when you take this law into account. So, if you're sitting there thinking, oh, we've got 12 months runway and it takes 6 months to raise funds, it's probably going to take 9 months to raise funds, and your cash will probably only last 9 months. So you better get going, kind of thing. But it's never too early to start fundraising is what we found, especially because it also helps you build that rapport with investors. If you have a discussion with them and you follow up 6 months later and you can say, look what we've done. We did what we said we would do. We've hit our milestones. The credibility you build there is absolutely valuable. So second question you might often get asked: how much are you raising? And I think there it's very important to be decisive, but show flexibility. Ideally we'd like to raise 10 million, but if we don't manage to raise 10, we'll do this and this with 5 million. So be decisive, but really have a bit of flexibility, and also be very clear on the use of funds. So, if your investors ask you, well, why are you raising? And you say, well, we're a startup and we're burning, and that's what startups do. That's clearly not a good enough answer. So, you need to really give that a lot of thought. Things like, we're raising money to hire 2 devs to work on our product roadmap. We'd like to spend some money on product market fit, and like to move out of the garage into an office. Be clear on those use of funds, because, you need to demonstrate what milestones you're going to hit with this money, what assumptions you're looking to prove, so that you can unlock the next round of funding. A question that I find tricky to answer is, what's your valuation? Investors will come in, they'll have a look, and one of the questions you early get is, what's your valuation? And I think it's almost meaningless to give a number unless you know what the investor's terms are. And a nice way to capture that is someone said, look, it's either your terms or my valuation, or my terms and your valuation. If an investor might say, sure, we'll give you your 200 million valuation, but it's going to be a 3 times lick pref, 8-year founder vesting, and full ratchet anti-dilution. Then, if you don't understand what those terms are, then, it's chalk and cheese, right? So firstly, those terms matter, the terms of economics and the terms of control. You need to really dig into those to make sure that you're on the same page. From there, I think a piece of advice that really stuck with me is get commitment first, then talk valuation with the interested parties. First reach the point of, do you like our business? Do you want to invest? And what Tanya mentioned earlier, articulating that vision, articulating your business, whose problem you're solving and why it matters, that really speaks volumes here. And, get your investors to buy into that first, and then say, look, we're reasonable founders. We're trying to get a reasonable deal. I'm sure we can, get the numbers to work out. So that was a piece of advice that stuck with me. And then finally, avoid the trap of trying to optimize for valuation. I think as founders, you're on LinkedIn, and it's you're seeing these crazy valuations and deals, and you often, it's a very public metric, the valuation, but it's not what you're trying to optimize for. You're sort of trying to optimize for a good deal with good investors, so that you can sort of get back to building the business. Fundraising is a massive distraction from the core, from building products that really solve users' problems. So really, a phrase I heard was, like fundraising and getting a deal is like being at a cocktail event where, someone comes around with a tray of snacks, and you better take something from that tray, because you never know when it's going to come around again. And I think that's the thinking there as well. If you've got a good deal or reasonable deal from reasonable investors, that's probably worth taking if it ticks your other boxes. Then I think another big one to answer is, why do you like our VC firm? Investors will ask you, well, why us? It's not enough to say, well, you're the most well-known and you've got money. You need to really think it through and find smart money from smart people that know your sector. Do your homework. You want to say, be able to say something like, look, we've seen how you've helped your portfolio companies expand from South Africa into the rest of Africa. That's what, on our roadmap. That's why we want you to invest and help us do that. Also, it aligns expectations, makes sure you're all on the same page. So that's quite critical. And another point that's become clearer for me over time is chemistry matters big time. The chemistry that you feel with these, with your VC, with someone who's going to be on your board, letting someone into your cap table is like letting someone into your family, to be honest. And the numbers matter, the deal matters, but chemistry with your VC partner, with the firm, with the, really matters. You're going to be in boardrooms, you're going to be in brainstorming sessions, and you really want to, have guys in your team who you just really enjoy working with. So I think that's something that became a lot clearer for us over time. Then another question is, is this a reasonable term sheet? And that's if you're a first-time founder, you haven't raised money before, it's very difficult to answer. There's big information asymmetry. If you're a seasoned VC, you've probably seen hundreds of term sheets. If you're a founder, you're lucky to have seen a handful. So, there's some mistakes you can't afford to make, and it comes to the term sheet and the terms in the deal. If you're trying to get your product market fit right and you spend some money on a few experiments and you make those mistakes, well, you're learning things that only you could learn. But if you make mistakes with a term sheet that you could have got input from, you could have got advice on, that's something you'll never forgive yourself for. So share that term sheet far and wide. I don't mean literally, don't email the term sheet as it stands with VC names to, everyone but take the salient points, summarize it, and share it for input. That stood us in good stead. As I mentioned, with fellow entrepreneurs, with old professors, you name it, guys are very willing to help, and help you get the structuring right, make sure that you are, doing and getting a fair deal. And it's a strong sign, if you get a term sheet with terms that are out of whack with the market and with industry norms, that then it's really a leading sign from, are these the VCs I want to be working with? But luckily most, yeah. Finally, what's the easiest way to fundraise? I think the easiest way to fundraise is convince investors you don't need the money. Ironic as it sounds, you just show that you got to sort of bluff your way through it, act confident, talk the talk, because, if you come across desperate, it's not a good starting point from there. And then negotiate hard, your VC will really respect you for it. It helps get things off to the right foot. And, they want to see that in you. They want to know these are guys that are going to fight for deals, that are going to close deals. I think that's a key piece. Don't be afraid to do that. That's it sort of from my side. If you're a budding entrepreneur, final thoughts, you must read Paul Graham. If you haven't already heard of Paul Graham, you're like, an Indian that doesn't know Sachin Tendulkar, legend of the space. And these two books, Secrets of Sandal Road, a great one, and then Venture Deals. A lot of exciting info in there. But I hope that was helpful. That's sort of been our experience, a couple of nuggets, and really keen to help fellow entrepreneurs navigate this journey. That's what those that came before us did for us. So we'd love to do the same. So thank you and good luck.
Thank you, Matt. Some amazing golden nuggets there. Your terms, my valuation versus my terms, your valuation. I absolutely love that. Thank you so much. I'm sure everyone's going to reference back to this session. Really, really good. We're gonna head on just for the sake of time, but appreciate you being here with us tonight. Thanks, man.
Thank you, Lo.
All right, guys. Our next big session is what are VCs looking for? We've asked Uwais Asmal, our CFO's head of advisory, to speak to some of the most amazing investors that we know. He's chatting to Rob Hersoff, Hans Otterling, and Ian Lessem about that. It's a pre-recorded session just to get everyone kind of in the same one, but the best 20 minutes you'll spend. Here we go.
Hello, everyone. My name is Uwais Asmal, and I'm the Executive Head of Advisory Services at Outsource CFO. Our topic of discussion for today is what are venture capital and investment companies looking for? To discuss this, we have brought you a powerful panel with over 70 years of collective experience in the venture capital industry. My guests today are Ian Lessam, Managing Partner at Avite, an investment company that specializes in early stage, high growth African businesses. My next guest is Hans Ottening, partner at North Zone Partners. North Zone is a technology investment partnership. Some of their more noticeable investments include Spotify, Avito, iZettle, Klarna, Appin, and many more. And my final guest is Rob Hersov, entrepreneur and chairperson of Invest Africa, Africa Capital Investments, at Deodam Partners, and deputy chairman at Vistage. Let's open up the discussion with the main topic. Hans, let's start with you. What are you looking for in businesses to invest in?
So, you know, the number one is always, you know, finding a team that are having this shared vision of building something fantastic, and it has to obviously to be a tech company, right? And if we look at Africa, I think, you know, fintech is obviously one sector that is extremely interesting. Health tech is another one, telemedicine, ed tech, third one. And then everything that can, you know, enhance trade, you know, remove friction in logistics, etc. I think if I you know, look at 4 sectors that I think is super interesting, those 4 are the ones that I would look at first when it comes to Africa.
Okay, that gives us a good summary. And Rob, maybe over to you. What stage in the business life cycle are you looking to invest in, and what is your reasoning behind that?
So on a personal side, as a private investor, I do look at early stage. And what I do is, as Hans said, I look at the team, because an idea on a piece of paper 10 years later won't look anything like the idea on the piece of paper. So you want a management team that can adapt and pivot on a dime. And I'm not mad about companies that raise a fortune and throw the money in the air and hope to conquer the market. That's an American concept. I prefer building a business that will survive bubbles and crashes. And so in my private life, I invest in early stage. In my more institutional life, I putting together a fund to invest in Series A onwards. That's much more institutional, but only technology now. I have enough bricks and mortar in my portfolio.
It seems like technology is a bit of a theme. Ian, I want to get your thoughts here. Do you also focus on a particular sector like tech? Or what are you more focused on, and what's the reasoning behind that?
At Avite, we invest in early stage technology companies in South Africa, East Africa, West Africa. Important for us is we only invest in companies that solve what we think are real world challenges. So quite importantly, it's got to be something that hopefully makes the world slightly better, given the pervasive challenges on the continent, and let's just say the rise of technology and the adoption thereof, and mobile penetration, etc. Technology can play a massive role in enabling solutions across the continent. We are quite an early stage investor by most accounts, so we post revenue seed all the way up to and including Series A. Similar to Hans, we do have a few themes, very much, as I said, real world solutions, so health tech, financial inclusion, safety tech, logistics, etc., things that either make people's lives better, make people's businesses better, and hopefully also helps African businesses not only attract the right talents, but also attract international clients, and you know, internationalizing their solutions.
And Hans, maybe you can just talk to us about the opportunities in Africa as opposed to the opportunities that you've been seeing in Europe. Is there a big difference? Where do you see the biggest opportunities, and where are you focused on?
So I think, you know, I'm very bullish on Africa. There are a couple of reasons. First of all, you know, Africa has the youngest population on earth. 1.2 billion people, and 60% are below 25 years old. And most of this young cohort of people, they have a mobile phone in their hand. in the next 5 to 10 years, this cohort of young people, they will change the continent. We're talking about 500 million young people, right? Massive amount of buying power, even if you look at, let's say, Africa. So I think that's a very interesting. Another very interesting thing with Africa is that if you look at an investment from our perspective, we always look at a couple of risks, right? We look at product risk. You know, is this product actually going to work? Is there a product market fit? We look at the market size. You know, is this a blue sky opportunity? Can this become a really big company? And the third thing we look at is actually team execution, right? And in Europe and US, we usually have all those three risks because we are usually investing in totally new technology, addressing a new market, and you know. But here in Africa, you know, you can actually take a lot of business models from Europe and US and China and Asia and implement them here in Africa. So you remove the product and market risk, and you only have the execution risk, the team, you know, which is a considerable advantage for Africa, right? And we see so many good, interesting investment opportunities in sectors, you know, where you have comps, other companies in either LATAM or US or whatever, that you can actually kind of compare to and see, you know, how can we build this company the smartest way, because there are other companies that done it before.
Okay, that gives us a good understanding. Excuse me. Rob, when I gave your introduction, it seems that you were involved in quite a few ventures. How do you manage all those varying responsibilities? Because you mentioned you're investing in your personal capacity and in your fund, while still giving the investee companies their due.
So first, you've got to back a great team. That's fundamental. And I've said it before, I've said it again, and that's the most important thing of all. But secondly, I always do things with partners. So, you know, Hans is one of my best friends, partner in a fund. Nick Ferguson and I are partners on an airport. And in many cases, I'm bringing the capital or the fundraising skills, the networking and top line revenue business development skills. And my partner in each case is usually bringing the other side of the equation, you know, the sector skill or the finance or cost-based focus. And that's the only way to do it. Have a trusted partner that you worked with and an incredible team. Otherwise, there's no way to do it all on your own. But also, I silo things. So, you know, I know where I have the greatest impact. And if I have a great partner or great management team, they know how to best use me.
Okay. So I want to switch tack a little bit. And I want to ask the question to each of you, and I'll probably start, Ian, I'll start with you first. But some people refer to certain types of business, the boring businesses. They tick along every year. They don't necessarily shoot the lights out, but they're consistently profitable. Do you only look at unicorns and 10x companies, or is there space in your portfolio for the boring businesses? Ian, give your thoughts, please.
Yeah, I wouldn't want to talk too much about the word boring. I mean, there's different types of businesses that can give different types of returns and have different types of you know, risk weightings behind them. So there's certainly nothing wrong with a business that provides stable cash flow, adds taxes to the economy, provides employment, etc. So I think the boring is not a great word. I think that there's different places for different types of businesses. On our side, we are a venture fund. So inherent to our business is to take on a little bit of risk, and in taking on that risk, our investors need to be compensated for that risk. So we are looking for what you would call your alpha returns. We as a fund, we don't focus on the word unicorn. We really look for what we think are real world scalable businesses. So the scalability for us is super important. So if you look at a problem, and sort of touching on the previous question where you say, what are you looking for in businesses? So generally, if you look at some of the most successful businesses in the world, or the most successful entrepreneurs in the world, there was a problem that they identified that was quite personal. So it might be a friction point that they have in their lives, their family may have it, their community may have it, and they start the business to try and solve that friction point. Now, that can be super important in the sense that if it's important to you, it's likely you're going to try a little bit harder You know, as when the chips get down, well, the chips are down, money isn't the only thing that's going to make your life better. You need to have something a little bit, you know, more than just saying, I'm trying to make some money. I'm actually trying to solve a problem that's important to me, my community, etc. But in assessing that, and Hans spoke about product market fit, what may work in a community, in a region, in a country, may not necessarily translate into other markets. So when we talk about scalability, and a common mistake that we see is that just because it's important to you doesn't mean it will be important to someone else. There's a very good chance it will be, because humans, we're not as complex and special as we think we are. We actually have very, very similar challenges. Although, you know, the scale and where you sit on Maslow's hierarchy of needs may differ. But the product market fit is really important to say, well, just because it works here doesn't mean it will work there. From our point of view, we focus on what can work in other markets, and why that's quite important. And Hans did speak a little bit around the opportunity in Africa, which is on the money. But as a market, Africa is not one market. It's you know, multiple micro markets. And if you're really looking to scale and to become a large business with impact, you need to be able to play in markets that are not just your home market. So you can't just be, you know, a Kenya business. You need to be an East African regional business. So Kenya has 50 million people. Through Comisa in East Africa, you've got 150 to 200 million people. That's a massive difference, right? You know, from a population point of view, obviously Nigeria is quite large with roughly 200 million people, depending on who you ask. So it's a little bit of an anomaly. But then again, South Africa, which is, I think, the third largest economy in Africa, we only have 50 million people, but 17% of our population is economically active. So you say, well, if I really want to scale, I really want to become large, we're not talking about unicorn, we're just talking about a relevant company by international standards. You need to be addressing your product, or your solution needs to address a market larger than your home market. We're speaking a little bit around regional solutions. So let's not discount the fact that many African solutions have a place in the world sort of economy. So Hans spoke about, let's just say, copying and pasting. I know it's not what he's saying, just for illustrative purposes, an international solution that worked in a similar emerging market, let's just say Southeast Asia. There are a few similarities there to some parts of Africa. Would work in Africa, it may and may not. From our point of view, we actually feel that the opportunity set is around local innovation, using the fact that they don't have access to traditional infrastructure, but have access to great technology to really leapfrog some of the solutions you may see internationally. So Hans spoke about fintech. I mean, M-Pesa, if you just, you know, if you exclude the recent adoption, because it's only been the last few years, of digital or crypto-based currencies, M-Pesa is the most successful digital currency in the world. I mean, they're doing like $16 billion worth of transactions.
Yeah, we'll run out of time.
So probably to that point is that let's not just think about bringing opportunities that are, let's say, localized, or just copying and pasting international opportunities locally. It's around what can we innovate and how can we scale that regionally and internationally. And those are really the types of things that we look for.
Maybe Hans, if I can pose that same question to you. Are you specifically also?
I mean, I think, you know, I agree with what Ian said, but and I'm not saying that we're going to copy and paste, you know, US business model into Africa. That's not going to work. But you also said, you know, we humans have some common basic needs, right? Banking, health, etc. Right? So I still think that there are a lot of bit models out there internationally that are applicable in Africa. That's my view. If I can just take 2 seconds and just share, you know, some kind of general aspects of raising funding quickly, right? And that's you know, when we look at deals, we always start with a team. We always start with a team. You know, that's number one, number two, number three. And then we look after blue sky opportunities. We want to see that, you know, if this is successful, the team can actually grow across borders. They can also grow internationally, right? It's going to be a blue sky opportunity. And then we are not looking for exits. A lot of presentations it has a slide saying, how we're going to exit. A great company we can always exit in a great company. We can either sell it to another investor, we can take it public, or whatever. But just focusing on building a great company. Don't focus on doing exits. And another thing which I think is important is that we are not experts. We are generalists, right? So and we are not business consultants. Some entrepreneurs come to us and they pitch and they say, "What do you think about this?" And we always have an opinion, but we are not the guys who are going to guide you to the right business plan. We are looking at business plans, we're looking at the team and say, "Wow, these guys have really something unique," right? But the day we started telling the entrepreneur what to do, when things go wrong, it's our problem. It's our responsibility, right? So obviously we are active owners when we have invested, but we really, when you come and present to venture capitalists, know exactly what you want to do, right? We're not consultants that you can sit down and have a discussion of what you're going to do. And then the last thing is valuation. A lot of entrepreneurs are striving for getting some crazy valuation. And the risk is actually that you raise a too high valuation. And then when you're going to do your second round, you have to do a down round. And it's painful for everyone. And it's really hard to do, right? The guys who invested in the beginning, they feel they're not going to be very happy. And people are going to ask, why did you fail of keep maintaining your valuation? So don't reach for these super high valuations or try to see, okay, how can I build a business from this valuation to the next valuation, which must be higher, right? That's my summary advice, right, to someone who's raising money.
Any add-ons to that question, Rob?
I'd just say, there's boom and bust in the world. I look at a 10-year plan. Takes 10 years to build a brand, trust, a golf swing, and a business. So think through where is this going to be in 10 years? Build your business for 10 years. Don't think 1 or 2 years.
I mean, that's a good summary. To end off, I want to pose this question to each of you. I mean, you look at lots of deals every day, or on a monthly basis. What is one mistake that you keep seeing over and over that founders keep making that put you off immediately? Maybe, Ian, we can start with you.
Well, I mean, look, I spoke a little bit around making that assumption that because your solution is something that addresses, something that's important to you, that may be important to someone else. So we see that quite a bit where you haven't really done your research in terms of the addressable market, to Hans's point around product market fit. But I think I wouldn't really say put you off, because a big part of our role is to try and let's say coach some of the entrepreneurs who may make mistakes along the way, whether we've invested or not. So I wouldn't say we get put off too easily. We try where possible and help as we can. But I think, Hans did chat on something which is quite topical around valuation. I think there's two things that probably are worth, talking through there. Number one, not all investors are the same. So different investors will add different values to the companies. So as Rob said, he understands his skill set, and he brings in partners who have complementary skills or skills that it's just not really his area of expertise. So he's over his course of his career and his journey, he's realized that. So the same for an entrepreneur is to understand, well, what are you really good at? What are you not so good at? Because everyone has things that they're not so good at. And how do I find a partner who can help, let's say, plug those gaps? And that's something that often doesn't come through. So often we'll say, well, what do you want an investor for? And they'll say capital. And you say, okay, well, that's a pretty easy answer, but there must be something more to it. And then probably the final thing is to what Hans was saying in terms of valuation, is not just about the price. So there are things, as we're talking about the right partners, but also there's many, many terms in there outside of price that can potentially trip you up down the line. And entrepreneurs often will get a little bit caught up in, well, I want to tell my friends that I just raised at this lofty valuation. We're not realizing that in actual fact, there's a few funny terms in there that you sort of overlooking.
Okay, we're running short of time, so I'll give you the last word. What is
Very
one
quickly.
thing that puts
Well,
you off?
It's dilution and being quick to fire. On dilution, people get fussed about, oh, I want to stay at 51, or I had 100, now I've got whatever. It's irrelevant. 5% of a multi-billion-dollar business is worth more than 50% of a $10 million business. So don't worry about dilution. Focus on the business, focus on building a success. And the second is, even if you're loyal to someone, even if you love them, even if they're your ex-buddy or a founder and they have a stake, if they're not doing a good job, get rid of them, fire them, cut them loose. It's better to fail quickly than fail slowly. So make decisions quickly, pivot, be decisive.
I love that. That's a great way to end. It's better to fail quickly than fail slowly. We've discussed some key points that investors are looking for, and I've definitely learned a lot. Gentlemen, thank you so much for sharing your knowledge and experience with us. Thanks, everyone.
Thank you.
Sure, guys. I have a ton of notes here. I am sure everyone does too. These sessions will be available afterwards, so you can go through that again. But yeah, amazing to learn from these incredible investors. For the sake of time, we are going to run to the next session. Damien, I see you're online with me already. We've asked our head cloud accounting manager, Damien Baker, to interview one of the best researchers on the venture landscape in Africa at the moment, Maxime Bayen, for us. Maxime, Damien, over to you guys. Can't wait to hear what you have to say.
All right, thanks, Lo. How's it going, Maxime?
Pretty good, thank you. Thank you for
all good.
having me.
Maxime, just for the viewers here, can you just give us a little bit of a breakdown as to what you actually do and how you add value to different firms in Africa?
Sure. So yeah, most of my time is spent with a firm called Catalyst Fund, where we accelerate startups, mainly in India, Mexico, Nigeria, Kenya, and South Africa. We have accelerated over 60 startups in the past 5 years, including Cheaper Cash, Soko Watch, now Wasoko, Lami, Koi Wise, just to name a few. We provide them with $100,000 of repayable grant funding and 6 months of very hands-on venture building. And so yeah, that's really what I do most of my time. And as you mentioned, I've also started a platform called Africa the Big Deal, where we're tracking investments into startups across the continent, as well as the weekly newsletter that some of you might have seen.
No, that's fantastic, Maxime. And what we've picked up there is a lot of investment coming into Africa. I just the last couple of days I started looking at some of the funds being pumped into Africa, and it's been billions of dollars that has been pumped into Africa. And it's a lot of US firms and European firms providing funding to tech startups and so on in the African region. So from your view, what do you see the venture capital landscape looks like on the African map at this point?
Sure, yeah. So as you say, there's clearly more funding coming in. Last year was 2.6 times more than the previous year. And actually, if we look at the first 3 months of 2022, the amount is actually quite significant. It's already twice as much as where we were at the end of the first quarter last year. So we're actually pretty much on track, if it continues at that pace, to reach close to $10 billion at the end of 2022, which will be another quite impressive milestone. So definitely way more funding coming in. The other thing that we're also seeing more of is the number of investors. Last year, there were over 800 investors that signed checks to startups in the continent. Of course, a number of them just put, let's say, a toe in the pool and just invested in one deal. But the fact that you see more and more interest from more people to invest in the ecosystem is also very encouraging. And just to stay on the investor, the other interesting point here is that we are seeing actually more and more Africa-focused, Africa-based investors in the continent. Actually, if you look at the investors who have done more than one deal, the majority are from Africa. So this is also another very encouraging sign. The last point I would like to mention here is that something that is also looking quite promising is the fact that the vast majority of deals at least for last year, was in the pre-seed and seed stage. So we can see the sort of the pyramid growing, especially at these stages, and there's yet to be seen how many of these will reach Series A, Series B stages, but definitely the base is here and the pipeline is quite full. So that's quite exciting times for sure.
Oh, there's fantastic opportunities that's lying ahead. And Maxine, I know that you are quite sensitive on time at this point in time, but just the last thoughts that I'd like to discuss with you is, if you were to give advice to companies looking for funding, based on your research and your experience, what advice would you give them, and what approach would they have to take to obtain funding for their companies?
Well, there's a lot to say on this, but to keep it a bit short, I'd say first, don't necessarily spend too much time on fundraising. Fundraise when you need the money. Don't necessarily be speaking to investors all the time. What you want to do all the time is speak to your customers and build your product. Speak to investors when you need to fundraise, and basically approach fundraising as a tech sprint. Allocate time for it when it's time to do it. Select your investors based on the type of sectors they're looking at, the investment thesis. Do your homework around that, the ticket size, and so on, and then reach out to them, all of them, in a limited amount of time. Schedule all your calls together, and really try to minimize the time that you spend on this activity. Unfortunately, I done a bit of a research on that with I think something like 50 startup CEOs in Africa, and on average they spend between 1/3 and 1/4 of the time fundraising, every year. It's huge.
It's a massive investment.
Yeah, it's time that they don't spend building, they don't spend recruiting, they don't spend talking to the customers, and so really that would be my main recommendation. Don't be obsessed with fundraising. Just really do it when it's needed, and approach it efficiently as you approach the other activities pertaining to your company.
No, Maxime, thank you so much. Don't let the search for funding pull away attention from the actual growth of your business. No, absolutely fantastic. Maxime, thank you so much for the time that you could make available for us. Really appreciate it, and all the best.
Thank you so much for having me.
Thanks, Damien. Thanks, Maxime. Great to see both of you guys. Appreciate the time. Guys, have a look at Maxime's research. If you haven't yet, I've shared in the chat just one of his kind of research documents and the link to his work as well. He brings out really amazing research. So guys, we're at the break now. We're going to have a quick leg stretcher. We're going to take about kind of 7-8 minutes, just kind of get up, refill your glasses, get your supper if you're in South Africa, on the South African time zone, and get ready for the next session. The first one after the break is a really amazing entrepreneur war stories. We're going to hear from 2 people who are actively involved in ventures, big and small, that have raised funding recently, and their journey in the 1 year post fundraise. So yeah, we'll see you guys in a couple, and enjoy the break. Let's sit back. Sam, I see you are with me already. And there is Mr. Pepe. Frank, thank you for joining us.
Hello, thank you for having me.
Brilliant. Thanks, everyone. Thanks for joining us back after the break. I see we have absolutely all of our participants live and with us this evening in South African time. We are really excited about this next session. We call it kind of war stories, 1 year post fundraise, more or less. We are talking to Sam Hutchinson, who is the co-founder of Sendmark, a very exciting local tech startup that's raised some funds in the recent period. And we're also talking to Frank Pepe, who's the vice president and global controller for a multinational organization based out in the US called Impact. Gentlemen, great to have both of you here with us tonight, and excited about this session and to see what we can learn from it.
Great, thank you for having us, man. Good to be here. I'm always impressed with what you do, Lo, so thank you.
Sam, no, that's very kind of you, man. They are so grateful for the incredible people we get to meet and the fun things we get to do all the time, right? Gosh, Jen, so maybe just for a little bit of context for this panel, would you mind just sharing like just the kind of like 30-second, 1-minute snippet about your organization? Like, what do you guys do? Where are you based? What are you doing? Kind of, Frank, can I ask you to lead us on that?
Yeah, of course. Impact.com is the world's leading partnership management platform. And what that means is we can manage partnership at scale, including traditional rewards affiliates, influencers, commerce content publishers, B2B, and more. We have a homegrown software that allows our customers to engage with partners globally to run campaigns from trusted, authentic partners, driving revenue, marketing, and clicks to their organizations and ultimately helping them grow their business.
Sure.
We believe we're creating a new channel to kind of drive revenue. From a size perspective, we're just under 1,000 employees. We have 13 legal entities, and we're geographically spread all over the world. And as you know, we have a center of excellence here in Cape Town, South Africa, with over 400 employees in DevOps, finance, CS, sales, and HR.
Jeepers. Frank, thanks for that. How many countries do you have clients in?
Right now, we have clients in probably 30 countries. And we have partners and publishers in over 145 countries.
Jeepers. Frank, thanks for being here with us. You represent the, let's call it, mid-size organizations on the call. Sam, over to you.
Yeah, I feel like I now represent micro organizations. Yeah, so I'm a 2-year cybersecurity startup. We solve a very important problem in a very boring sector, which is email. So there's a fundamental problem in email where cyber criminals can send an email from just about any organization in the world. And that problem is called spoofing and impersonation. And we globally stop that. So Frank, I see, well done to you guys. You've employed the technology that we promote. You've got a few mistakes, so one day I'll help you.
Yeah, hey, Sam, we have to meet up after this.
Yeah, so, but that's what we do. We're globally making the internet a safer place. And we're solving a major problem with email. Yeah, we're 2 years in the run, been good fun so far.
Thanks, Sam. Thanks for keeping us all safe, and great to see business happen here on the platform tonight. That's really cool. Gentlemen, just as a kind of a starter question I want to pose to both of you. So both of your organizations have kind of chosen to raise equity capital, sell some shares to raise some money to grow the organizations faster. I'd love to hear your arguments for why that model, as opposed to kind of like growing organically from funds from clients as one goes, as so many founders do. Maybe Sam on your side. Yeah, please.
Yeah, so I think the best time to start a business is sort of in your late 30s, early 40s. That's when you have the most skill and the most experience. The problem is you often have a family, and to put that all on risk is just close to impossible, right? So now to solve that problem, you got to raise VC, but it's not just about employing yourself. If you want to get some of the best talent in the world, you got to be able to pay those people as well, right? And if you want to be the best company in the world, you need great people, and it's almost impossible to bootstrap that. I don't know how people think that they can build global organizations with some sort of sense of funding. I mean, it's close to impossible to bootstrap that stuff. And if you look at all of the, I would say most of the greatest tech companies in the world, they've all gone through some sort of phase of funding. That's what I believe. I could be proved wrong, but I don't see it happening other ways personally. Frank, I don't know, what do you think?
Yeah, I mean, when I think about it, when you have what you believe as a company to be some type of market leading product, and you really need to just spread your wings and get the word out there, kind of a more geographic spread, more AEs, and you're seeing both the adoption from some of the logos that you could see on Impact's website, and you're seeing the usage of the platform and how those customers are using it, you know, you kind of hit that stride where you're like, if we can get some of these major players around the globe and some of these major logos to use our platform as a startup, imagine if we had the ability to expand our outreach faster through different countries, through AEs, through technology advancement. So I think it's not that you necessarily need to do it, but I think if you have what you believe to be a market leading product, or a product that'll solve a problem in the world, you know, it may make sense to kind of reach in and expand rapidly with some of that additional capital.
Love it. Love it. Thanks for that perspective, guys. So Sam, we spoke last year on this very same platform on the War Stories panel at FundRaise Con, more or less the same time of the year. And you guys had just closed your round. What has been happening at the company since? Tell us a story about the last year.
It's been an amazing year for us. I mean, I think about a year ago, we had about 60 customers. We now have about 500.
Oh.
We 7 times growth in the last 12 months.
Gee.
We hit all of our targets and are exceeding all of those. So, I mean, we have customers all over the world, NASDAQ listed entities, customers in South America. We service many, many companies on the JSE. Yeah, it's been going good. There is no doubt there is still pain. But I think the pain is a bit different. We have aspirational pain. Like at Stenmark, we want to be a world leader, and not achieving that potential is really what keeps me up at night. I mean, it drives me crazy. What can we do more? Is always the question we're asking.
Yeah. So I think in a small mid-sized organization, and even in a larger one, probably when it's growing fast and raising capital to scale, there will probably always be pain of some sort. I have yet to meet the business owners in a company that feel that everything is smooth sailing and they're changing the world and rapidly scaling up. So yeah, I think it's part of the ball game, just kind of leaning into that, right?
Yeah, one of our problems is we have over 3,000 customers experiencing a POC with us. I mean, if we can just meet those at our close ratios, we'll triple this business. It's just grabbing the opportunity in front of you. I mean, it's hard work, eh? Yeah.
Frank, if any of the investors on this call invest in you guys after this talk, we're looking for a commission on it. This is just too good to be true. Well done, man.
Thanks. And by the way, I've only been here 14 months, so I think I was the benefit of some of the prior rounds of fundraising. And I was kind of one of the newer people. I came in and had experienced growth in the startup space before. So I can't take any credit up until this point. I got on a fast moving bullet train and have kept it going.
Sure. So Frank would love to speak about that bullet train, because I believe if Crunchbase is correct, in 2008 you guys raised $400,000 and your last round was $150 million. So quite a sizable jump in not all that many years. It's really unbelievable. Kind of would love to hear just kind of like what has made that possible, like from your perspective, even if it's just the last $150 million round that you speak to, like what the hell makes it possible to raise that kind of funding?
Yeah, I mean, I would think one, kind of the technology that we have and being a market leader in the space that we're in, as well as driving people to understand our space and having reasonable competitors kind of pushing us and showing the adoption is helpful. So we spend a lot of time kind of educating the market, educating investors kind of about the space that we're in. And sometimes when you're creating a business that's meant to solve a problem, a lot of it is just getting people to understand what problem you're solving and why that's kind of a benefit going forward. Sure. I think two, historically illustrating what you've done with existing capital by looking at some of your KPIs, whether it be ARR growth or kind of cash burn, or how you're effectively utilizing, not in so much detail, but how you're effectively utilizing the existing capital to grow the business. Sure. I think investors look at that and they kind of can do exactly what you did. Look at Crunchbase. They can kind of see when we had the capital raises, they can, see some of the growth that comes after those capital raises and some of the strategic investments that we've made. And they can kind of think into the future that, well, this additional money can kind of be put to the same use to continue to grow X, Y, and Z. I think three, and this is probably to everybody here, they say the best time to raise capital is when you don't need capital. And kind of be opportunistic about it. So when you have a healthy balance sheet, limited to no debt, and even through a pandemic, when you're growing, and you kind of hit that, that level where you don't necessarily need to raise capital, then you become a very exciting target to liaise with in regards to, raising some funds.
Yeah, love it. Yeah, that's been a theme. I think that we've heard all the investors mentioned tonight, speaking about, raise when you're not hungry. If the company is starving when it meets with an investor, it's a lot more difficult to get a deal concluded, right? Sure. Frank, one more question on your side. We just love to understand, because you're in the finance team. We've got quite a lot of finance professionals and M&A specialists on this call today, as well as entrepreneurs and investors. We'd love to just understand the finance team kind of process and timeline and complexities around a transaction like this. What has been your experience?
First and foremost, everybody here, I will say it's extremely disruptive to any of your other finance goals. Actually, that's why we met Lo, because he helped supplement some of our finance organization during this time. Shout out OCFO. So you have to mentally be prepared as a finance leader for this to be disruptive. Don't overburden your staff, with other goals or OKRs, and effectively communicate upward to kind of non-finance leadership and company leadership that in doing this, you may not get to X, Y, or Z. So I do find it to be very disruptive. Two, there's a lot of granularity in what people who are looking to invest in your company are looking at. So don't only be prepared to provide kind of the high level reports, the due diligence and how they're going to pick into every number and every trend. It almost feels like a game of gotcha in the sense that they'll be looking at a linear trend and they'll point out a month or a quarter or a metric that may be off and dive in and pick to that. So I think as you're creating the information that you want to put in front of investors, really vet it internally and challenge yourself, to be very disciplined and say, does this look right? Think like an investor, find, what could be wrong. And that's not a detriment. There's many reasons why your metrics aren't the same quarter over quarter and why your growth may not be linear or choppy. But the ability to effectively answer that in a concise, knowledgeable way, I think provides people comfort that you're managing the numbers and the numbers aren't managing you. So, those would be my two pieces of advice. One, plan on it being very disruptive. Make sure you're not overburdening your team. And two, really be thoughtful as to what numbers, OKRs you're presenting, and challenge yourself to look at those numbers before they go into an investor pack or into a FundRaise share drive. I have a bunch of investors who are, come from the smartest universities and banks around the world, kicking the tires harder than a light tap.
Yep, and that's very well put. And if you put something out there that you haven't thought about that well, it's going to come back at you, right? Just create more work and more complexity. So no, I love that. Sam, the actual investor that is looking at you and going through that process with you is also quite an important part of the puzzle. As we've heard, there's a ton of capital coming into the market, new investors, new funds, existing funds raising more money. There's a lot of money doing its rounds around the world at the moment, especially flowing into Africa at the moment too. Sam, like thinking about like who your ideal investor or investors are, like what would you say are the main considerations? What were they for you, and what would you advise to the other entrepreneurs on this call?
Okay, so let's assume that money has a 10 to 15% variance, right? Because I want to make this clear. Having the right amount of money in your bank account is the most important thing to help you enable your business. Now, so if we're just assuming that those things are all the same or similar, I'd say 10 or 15% variance. The super important thing to us is that our investors are our partners. So a strong alignment of value and culture is very, very important to us. I mean, we win together, we fail together. If we have done something wrong, our investors know that we've almost died trying to fix it, right? So we're all on the same team. That's a very, very important thing. And then the other very important thing for us about an investor, which is like definite added benefits, is if they can help us get access to the markets that we're looking for. So for example, we're very focused on managed service providers or system integrators, and there's certain VCs that specialize in investing in tech companies that service those sorts of sectors. So if we can work with people like that, that's phenomenal for us. They can make the right sort of calls. I think those are the main things. Besides the funding, which is important, values is the most important, and then access to markets.
No, I guess, whether it's investors or customers or employees, you're dealing with people at the end of the day, right? So that values alignment is always so critical, even more so if it's a capital partner that's going to actually hold shares in your organization. That's absolutely critical. It's not like you can just, part ways amicably very easily. So I love that values alignment that you raise as the number one point. I'd love to hear from both of you also while we have the last few minutes, just in terms of, what you think the number one thing is that would make an investor want to invest in an organization. Like, what is that kind of like that big thing that stands out for you guys? Frank, over to you first.
I think for just kind of clarity to anybody who's out here, looking to invest, I think it determines what stage that you're in your organization. So for us, looking at our ARR, I think companies are looking at what our ARR growth has been and what our ARR growth trajectory looks like. I think that's very important because that's driving a lot of valuation in the SaaS space. And I think too, as you've seen a shift in the market, and again, we're a little bit later stage, being 9 years old, or having had a commercial product for 9 years and having raised a recent amount, I think there's also that new feel in the market of they can drive ARR growth. Will they be able to turn profitable? Post IPO or sometime in the future when that becomes important in the valuation. So, I think based on the stage you're in, I think investors are looking at a lot of different things. But I think for our investors, it's that continued ARR growth. And, will there sometime be a way to, to stop cash burn and to have positive EBITDA?
Because stopping cash burn is what makes giant tech companies work so well around the world today, right? Sam, over to you. What are your thoughts?
Yeah, I absolutely agree with Frank. I mean, I think, but if we look at the different stages, what they're interested in, if you're like a startup or you're looking for seed or any of that sort of funding, they're mostly investing in the people. But then as you sort of get to post Series A, Series B, they're definitely looking for the people and the business model and the ARR growth and the scalability, defensibility, moats, all of that sort of stuff, right? So then it becomes like a proper investor conversation, I would say, post that. And then as you get even bigger, I think it becomes a little bit less about the team and much, much more about the business, right? Because if you're going to do things like potentially IPO or have a mesh sort of strategic exit, the business is the thing that people are going to be buying. Leadership helps, don't get me wrong, but it becomes less and less. I wish that I mattered more, but I've come to realize that the business starts to live without me. It's a very important
Well, that means you're doing your job as an entrepreneur, right? If the company can start functioning without you, that is the ultimate goal, right? To build something that can run even when you are not there to make it work. So no, well done on that. Sam, I wanted to ask you this question really badly. Like, so you're building a global company, but you're doing it from South Africa. Just because we have a lot of people from South Africa on this call, I'd love to kind of just hear your thoughts on that. Like, why choose that in today's time and age?
I wish I had a glamorous answer, but the reason that we're doing it from South Africa is just because we happen to live here right now. And this is the network that we know. So if you're in South Africa, you've got to be able to try and get South African customers. But we are busy. We're setting up a holdco in the Netherlands, and we now have partners in the US and in North America and in South America. But the truth is, if I was born in America, I'd probably started from America. Right? Sure. I mean, it's probably just the real function. But I'm very conscious, especially in the modern sort of online world, and I mean sort of post-lockdown and COVID, it's much easier to get customers anywhere. So we have customers just about everywhere, and COVID has enabled that. Yeah. So I hope that wasn't really a glamorous answer, but it's just practically true. No,
that's perfect. It's a fascinating time to be based on this side of the world. I think, from a talent pool perspective, as well as a time zone perspective, and the command of English language, and a couple of different reasons. There's a couple of different reasons why an organization like Impact plants, 400 of their people, I guess, in South Africa, and why so many exciting companies are being started and scaled and exited here at the moment. So yeah, I'm finding that quite interesting among the client base. That's really cool.
Extend on that, I think that it's been very easy to deal with other Western English speaking countries, and it's just because South Africans are highly skilled and speak well. So
spot on.
Simple as that.
Thanks, Sam.
And Lo, I was going to say, you kind of took the words right out of my mouth. I feel like that came from maybe our meeting a couple of weeks ago or a couple of months ago. When we talk about investing in South Africa. You have a very high functioning education system. So great education here, great universities. You're also center of the world. So our, center of excellence in South Africa can manage Asia in the morning, the EMEA region in the afternoon, and then support America in the evening. High level of English language, in a relatively young workforce and a young and improving workforce as well. So, you can kind of get people early and let them grow into their roles. especially as a startup or, somewhere where you're still kind of fundraising. So yeah, that's why kind of we look at South Africa.
No, appreciate that, Frank. And Sam, to both of you guys, we're unfortunately out of time for this session. I am still in awe of the two organizations you are building at different stages of building amazing global companies. Thank you for sharing your insights and your war stories with us. It's been really interesting to learn from you, and I'll connect with both of you shortly. Thanks for sharing your details as well. If anyone wants to connect through our platform with you guys as well, we'll send the details right over to make sure they can reach you. Thanks for being so open.
Will do.
Have a good day, everybody.
Thank you,
Good evening.
Sam,
Thank
pleasure.
you, Frank. Thank you, Sam. Speak soon.
See you guys later. Bye.
Bye-bye. Okay, Tony, I see you are online already with me.
Yes, good evening.
So great to have you. How are things on your side of the world?
It's going good. It's down here in Lagos. It's a pleasure to be part of this year's edition of FundRaise.
Brilliant. It's amazing to have you. Tony is going to tell us a little bit about building unicorns in Africa. And without stealing any thunder, I'm going to hand over the microphone to him to tell us a little bit about the InterSwitch story that he is a key part of. Tony.
Great. So good evening, everyone. It's a pleasure, to be here. So 3 years ago, InterSwitch became the first unicorn in Africa. It took us 18 years to achieve this feat. And in just 3 years after we achieved this attainment, over half a dozen unicorns have emerged from the continent, and the number keeps increasing. In 2001, for example, 4 unicorns emerged out of Africa, and it took an average of 4 years, shorter than how long it took InterSwitch for them to reach unicorn status. I believe this is only the beginning of a wave of more to come, as fearless entrepreneurs and their funding team continue to build for the continent's future. Now, before we talk about building unicorns in Africa, we need to understand how we got here. You see, the origin of any business transaction, trade, or commerce it starts with a communication of intent between a willing seller or provider of service and a keen buyer or consumer. Basically, communication ignites any transaction, which would usually involve the exchange of value that happens on the back of some form of a logistics and arrangement. You see, 30 years ago, transactions were not seamless across Africa because communication was difficult. And the first phase of the African ecosystem, or rather tech ecosystem evolution, changed it. And the first phase is the GSM revolution. And entrepreneurs building on improved communication to make the transaction process more seamless. Until the early 2000s, communication, like I said, hampered the free flow of commerce across Africa, and the GSM revolution changed it. The introduction of GSM across sub-Saharan Africa made communication much more seamless across the continent as telcos built the infrastructure that enabled this connectivity. Now, at the same time, young and bold entrepreneurs like Michel Elegbe and the founding team of InterSwitch took it upon themselves to build infrastructures that created payment enablement solution running on the back of this new interconnectivity to make the transaction process much more easy. Now, this is the same case for guys like Asfat Sabri and the Fauri founding team, who also levered on the telco infrastructure to build payment solution. Now, still during the first phase, communication was still not as seamless as it is right now. And if you're wondering what I'm talking about, remember a time where the coolest gadget in town was Nokia 3310. Now, for the younger crowd, imagine a world where you can only send use your phone to send SMS and make phone calls, and having a calculator on your phone was more of a luxury. There were entrepreneurs that leveraged that limitations to build for the future of Africa. And InterSwitch, Faori were the key unicorns that emerged from that phase. Then in early 2010, we saw the second phase, the digital revolution or transformation. We saw improved connectivity across the continent through the rollout of 3G and 4G wireless mobile telecommunication technology rather. Now, building on this improved connectivity, increased internet penetration, increased broadband, we saw the expansion of digital value-added services, or rather, we saw the digital expansion of value-added services. We also saw the breakdown of artificial borders across the continent, which made it easy for startups to grow across the continent geographically more quickly. Now, the second phase, the digital revolution or transformation, was also aided by advances in cloud computing, which made it much more easy to scale quickly at lower cost, adoption of mobile money, which made it possible for a lot of the historically financially excluded to become part of the financial ecosystem, global technology incubators and accelerators being more involved in the continent that helped founders define and build their initial product for scale, and also increased flows of global VCs in Africa that changed the funding landscape. I'll tell you a story about InterSwitch. Some of you may not know this, but InterSwitch has only raised capital once, because by the time InterSwitch founded, we didn't have global accelerators or incubators, or we didn't have global VC investing. Now, every of our fundraise you've heard have been basically secondary capital because we were limited. So it's amazing to see how that has changed over the years. Now, something to note when you compare both the first and the second phase was that while the first phase enabled in-country connectivity, the second phase allowed for cross-border commerce. Furthermore, while engineering solutions drove the first phase, the second phase was driven by technology and more digital solutions. Now, key unicorns that emerged from the second phase included Flutterwave, who's building a payment infrastructure first for Africa, and now they're now focused on global merchants as well as payment service provider, Jumia, providing e-commerce and logistics solutions across the continent, and Della, taking Africa engineering talent global, Wave and OPay, providing financial services across mass markets, and Cheaper Cash, also helping solve, our payment issues, cross-border payments. Now, that we have an understanding of how we got here, the question is, what is the next phase? It's a question for the bold entrepreneurs and investors here today, but a key starter, right, is to the entrepreneurs here, what solutions are you creating for the future of the continent? And for the investors here, how do you choose to deploy your capital? But here are some hints. Now, whether InterSwitch, Faori, Flutterwave, there are two key themes when you look at the stories of these companies. One is a lot of these companies focus on building infrastructure for the future. Now, in the case of Faori, Flutterwave, and InterSwitch, for example, we did that with payments, building infrastructure that enabled seamless transactions. Then the second is leveraging on existing infrastructure to build value. Andela doing that with talents, Jumia doing that with e-commerce and logistics. You have financial inclusion, OPay and Wave, and then cross-border payments with Cheaper Cash. Another thing that you would also look at that resonates is that these guys are solving Africa's problem. And there are several challenges facing the continent today. And to the entrepreneurs here, which of them are you solving? Some of them, so I'll go through this quickly. One is we have issues with import substitution, for example, right? Africa is the largest exporter of natural resources, but at the same time, we import almost everything. There are opportunities in import substitution. There are also opportunities, around, financial inclusion, cross-border payments, education, healthcare, and so on. The last thing I would mention before I, end this is that when you also look at most of the guys, they are fearless founders and founding team that charted the course, persevered when it all seemed lost, believed in their dreams, stayed focused, and never took no for an answer. Sure. And lastly, it was never about building a great product, but it was about building products that fixed the problems of Africa. Now, I'll conclude by saying, building a unicorn is not about valuation. It's about creating value while solving the problems of Africa. Thank you.
Tony, that is a beautiful tagline. You should make like a bumper sticker or something like that. Appreciate your time. Thank you for sharing that amazing journey with us. It's unbelievable, and we're all watching you in awe as you take center stage on the continent. Thank you for that. Great. Tian,
thanks for having me.
Great to have you. Tian, are you here with us?
I am, Lo, yes.
Great, guys. We're so lucky to have Tian Smith, who's the transaction director at Benchmark International, here with us today. Benchmark is one of the best outfits out there in terms of preparing a company for sale. They're experts in the exit process. So for all of the founders who are building a company that they ultimately want to sell for a really good valuation, Tian and the Benchmark guys are your people to speak to. We've asked Tian, how do you build to ultimately be able to sell? So Tian, over to you. Thanks so much for being with us.
Thanks, Lo, and much appreciated. Really, thanks for the opportunity to be a part of your event this year. Really enjoyed listening to all the speakers up to this point. Maybe just as a brief introduction, as Lo had mentioned, I work at Benchmark International. We essentially are global sell-side advisors with our head offices actually sitting in Tampa, Florida in the US. And then we've got a presence in the UK as well as in Ireland, and then more recently in Germany and Europe, and then of course in South Africa as well. So how to build a business for sale is such a relevant topic, one that would probably be nearly impossible to cover in 10 minutes. So I'm going to try my best. And as most of the discussions today was focused on early stages of business, I'm really glad to see that one of the topics deal with exiting of a business. And as many people understandably so focus on their journey through a company and often fail to discuss how they plan to leave and exit. I hope that some of these points I touched on will be relevant to the listeners tonight. So questions that I believe that a business owner should ask themselves probably more often is, when the time comes to sell the company, what will make it attractive to buyers or acquirers? How can they be sure to obviously obtain a fair price, and what can they do to actually prepare for sale, and how long that process takes? Now, considering the speakers and the listeners or the audience this evening, I've got absolutely no doubt that there are individuals that are way better placed and more experienced in building businesses than myself. So I want to frame the topic slightly differently, and I hope you don't mind, in focusing on exiting a business, but I want to do that through focusing also through the lens of a potential acquirer. And every entrepreneur exits eventually. It's one of the few absolute certainties in business. Assuming you've built a viable company and a good asset, you would ultimately be in the driving seat in terms of choosing when you want to exit. Now, as global sell-side advisors, we have the privilege and the honor to deal with entrepreneurs and business owners, as well as a broad range of acquirers, locally as well as internationally, on a daily basis. And therefore, really understanding what makes businesses more attractive, what are the main obstacles that get in the way during a sale of a business, and then also typically what influences not only the price and valuation of a transaction, but when the time actually comes to exit, as well as what the probability is of concluding a successful transaction. Now, perhaps to position the discussion, I would like to encourage the listeners to not only think of exiting a business as an event, a once-off event, but instead of thinking of it more of a phase of the business, just like a startup is a period or a phase of the business. There are many factors that obviously affect how successful your exit will ultimately be. And I'm going to try and touch on a few points that would hopefully assist some of the business owners, entrepreneurs on this platform in their thought process as they enter that phase of the business. And again, unfortunately, due to the time constraint, there are a number of other points that are also relatively important. I would, however, like to touch on 4, and these topics form part of all discussions that we have on pretty much a daily basis when business owners are looking to exit, and it undoubtedly affects the value or the probability of successful concluding a transaction. So the 4 points is, how do you remove over dependence in various areas, which I'll touch on a few points under that. How to create a sustainable competitive advantage. In other words, what makes your asset obviously more attractive. How to build recurring revenues and sustainable growth and earnings, and really focusing on that, which any acquirer is interested in hearing. And then obviously establishing strong systems and really focusing on keeping good financial records, which I'll touch on and is also a point of discussion in pretty much every meeting we've got with any acquirer. So firstly, how to remove overdependence. And under overdependence, there's a few things I want to touch on. And the first one is overdependence on the actual founder or the owner. And we often hear this. I'm sure any entrepreneur that has gone through a first finance round has heard around the founder at that point in time. Maybe in the beginning it's slightly different, really being dependent the business on the founder and the owner. And as you continue down the journey and the business gets more mature, is often what the founder or the owner, the mistake they make is they kind of become synonymous with the company. And although remaining at the center of the business, can be understandable at an early stage of the business, it really causes a host of growth barriers and some big roadblocks between you and a fair price when you really decide to exit. Any acquiring company wants to see that there's a management layer in place and that the management team has some sort of a long-term incentive plan that will really encourage them to stay after the business is acquired. Now, it doesn't necessarily mean that incentive needs to be in the shape of equity. It can be in shape of incentive schemes. It's just important that there's some sort of alignment between the management team as well as the particular acquirer that you might have attracted. The second point under overdependence is customer overdependence. I'm sure everyone that's gone through a finance round as well is there's a very heavy reliance on what does the customer concentration risk look like. And relying too heavily on one client or customer is risky and will definitely turn off certain potential acquirers. So typically the rule of thumb when we deal with exits, it's to ensure that a client doesn't make out more than say 10 or 15% of contribution to revenue. Understandable when a business starts off, beggars can't be choosers. You're not going to show business away. So again, slightly different early stages of a business, but certainly from a risk perspective is really to try and throughout the journey is to diversify your revenue streams and really minimize your customer risk or concentration. Thirdly, supplier concentration or supplier overdependence, shall I say. Often everyone looks at concentration risk from a customer perspective, but kind of neglect the supplier overdependence. And we've had a few instances over the last 6 months, 12 months where this has actually become a real issue in the final stages of a transaction, where at some point in time, especially during COVID is a good example, where a lot of the customers or clients or the shareholders were reliant on international importers bringing in product or raw materials. They didn't have an alternative supplier. And what that left them with is obviously less leverage, having to increase the cost of sales, pressure on margins, profitability decreases. And again, I'll speak to sustainability of earnings in a bit, and ultimately driving the price or the value of the business down. So definitely something to keep in mind. And then lastly, employee overdependence, as your business relies on where your business relies on a very small handful of employees. Now, a common theme, and I'm sure most of you will agree with this, but a common theme that I've heard for a long time now is that good people are hard to find. And so often what happens is that when a company finds a good candidate, they understandably tend to place over-reliance on that individual or individuals, which in itself poses a risk. The second point I wanted to touch on is something that's also all too familiar for any entrepreneur, is finding a sustainable competitive advantage. And most potential acquirers we deal with look at hundreds of opportunities a year, if not a couple of hundred a year. And fortunately for them, they can do this, and they only have to select, perhaps depending on their appetite or capacity, 2 or 3 of those opportunities. So this is why it's extremely important to, again, through the journey and the phase of the business, to try and really figure out what makes your assets more attractive than the alternative for the acquirer, or what makes your assets more attractive for the acquirer. What is that black box, and what's the magic behind your business? And if your business has a sustainable competitive advantage, it will be difficult. It will be costly for competitors to emulate your business and to take market share. What we often see, and we always try and share this with our clients and shareholders up front, is that when an acquirer looks at a business, they don't necessarily only look at valuing a business on the financial statements or valuing it on the balance sheet. They really do look at it from a strategic perspective in terms of what is their best alternative in terms of acquiring a business. If they don't acquire your business, what else is out there? So if you understand what your sustainable competitive advantage is, you definitely have a lot of leverage when it comes to those kind of discussions. Thirdly, recurring revenue streams or sustainable earnings or growth. It is no secret, obviously, recurring revenue models are extremely appealing to investors for a number of reasons. We've probably seen more of that over the last 12 to 24 months, as we are also taking on more companies with these type of business models or revenue models. Specifically from software development or software-based businesses and tech-based businesses, mainly due to the predictability of the cash flows. It contributes to scalability. With positive, predictable cash flow, you are also obviously able to push cash back in the business with less risk and being able to predict it. And then probably the most powerful of the key benefits is the customers you acquire and that relationship that you build over time. And that speaks to the sustainability of the earnings, which we find is really a point of focus over the last 12 months for any acquirer. And then often this isn't probably worth mentioning, is that this sustainability of earnings is often tied to the structure or the construct of a deal when the time comes to exit. A very simple example would be if the sustainability of the earnings cannot be justified or confirmed at the stage of closing, typically you would find some kind of an earn-out structure or deferred element to it, really just to mitigate the risk from the acquirer's perspective. And we see this in all kinds of transactions, all shapes and forms. Again, if all of this is in order and you can really show that you've got recurring revenue streams, as well as prove your sustainable earnings, then hopefully this would become less of an issue, and you can focus on achieving a higher payout on closing. And then maybe as a last point, establishing strong systems. And I'm going to include keeping good financial records. Lo, I'm sure you can attest to this, but I'm going to include this under this topic. Businesses that are built on good processes are simpler to run or easier to run. They're typically more profitable, and they're certainly more attractive to acquirers, as it poses less risk to an acquirer. And ultimately what you want for your business is for the systems to run the business, the people to run the systems, and then for you to lead the people. And with regarding to keeping good financial records, especially dealing with the larger companies, the listed companies and the international acquirers, what we often find is that the clients or the companies that we assist with or facilitate the exit, when their financials or their record keeping is not up to scratch, it can very often be the culprit of either deals falling over or deals being delayed for a significant amount of time, really losing momentum throughout the DD process. What I'm not suggesting is that you, as a founder or owner-run business, cannot run personal expenses through it. There's ways to obviously normalize that and to reflect it, or to get to a true reflection of the financial records. But what I am suggesting is that when you do run personal expenses through the business, or when you do have some add backs to take into consideration that's justifiable, is just to keep the record and to keep the source documents to that information, which would make it so much easier when you actually get to that point in time when you are dealing with the financials and the due diligence. And then perhaps in closing, I'll touch on the million-dollar question, and that is, when is the right time to sell? Now, we often hear the saying, willing buyer, willing seller, and something that I certainly believe is overlooked, and we see it more often than not, is the element of timing. Now, I almost want to use the same analogy that Matt used earlier this evening in the talk, where he said that investors partaking in a finance round, it's like being at a cocktail party and someone comes around with a tray of snacks, and you actually don't know when they will come around again. So you better take some snacks when they're next to you. And the same goes for acquirers. We have closed transactions where acquirers looked at a specific transaction 3 years ago, and the business didn't change significantly in 3 years, but back then the timing wasn't right for whatever reason. And a couple of years later, we've successfully closed that transaction with exactly the same retailer in this example. So never underestimate timing. And my advice would be is to always be on market. Acquirer strategy changes with time, and more importantly, so do their priorities. So don't make any assumptions on whether there would be interest or not interest. And I would encourage you to have the discussions and really let the market speak for itself in terms of whether there's interest and not interest.
Sure, Tiaan. Wow, thank you very much. That's such a good structure that you've just unpacked for us. I think, everyone that's thinking about, building a company that ultimately want to sell can definitely gather a lot of golden nuggets from there. Thank you very much for joining us tonight. I really appreciate the time.
Thanks, Lau.
Great. Okay, guys, we have one more panel and one more keynote to go. We're going to ask our co-founder, Donna Pretorius, to join me on stage, as well as Sean Malana from Investec. Sean, so good to have you back here at FundRaise Con. We're going to speak about entrepreneurship programs. Donna, Sean, I'm going to leave the floor over to you guys. Thanks for being here with us.
Thank you so much, Lau. Sean, it's so great to have you here at the conference. So for everyone that's listening, Sean Malana is the Entrepreneurship Portfolio Manager at Investec CSI. Sean.
Hi, good evening, everyone. Thanks, Lau. Hi, Donna again. Good evening to all the guests that you have on your conference this evening. Thank you very much for having me again. Looking forward to the chat.
Sean, I'm super excited about our discussion today. You work with a lot of entrepreneurship programs at Investec CSI. And for the audience, I want you to tell us a little bit more about the heart and the passion and the why. Why is entrepreneurship so important for Investec CSI?
Sure. I think, I'm sure most of you would know Investec in the context of, what they present, but I think a huge part of the Investec DNA is very much entrepreneurship and entrepreneurial. It's just part of how the organization was founded, how the organization is run, and really the individuals that, contribute to what the organization is as well. So I think the entrepreneurship is just something that's inherently part of the culture, part of Investec, and just part of the whole zebra ethos at Investec as well. And I think more importantly is Investec is an organization that very much believes in living in and not off society. And the society in which we have, particularly in the South African context as well, there's huge divides, there's huge disparities, and it's trying to figure out and understand how we can invest within initiatives or strategic intention to try and bridge this divide and this gap. And for us, education and entrepreneurship are two of the fundamental keys that we believe can impact and provide the change and the necessary tools and skills to kind of solve for a lot of the social ills and economic woes and problems we currently face in South Africa. So that's why education and entrepreneurship stands for us as the fore of all of what we do within CSI at Investec.
Sure, Sean. Yeah, as outsource CFO, we've been working very closely with you and Setlhogane. And I can truly say that Investec CSI really have a passion and heart for entrepreneurship. One of the programs that we work very closely with you as network partners is the Finance Readiness Program. It's the 5th year that we're running the Finance Readiness Program. Would you be so kind to tell the audience a little bit more about what's the objective of the Finance Readiness Program? What do we aim to achieve?
Yeah, sure. No, it's been a great partnership over the years with OCFO. And what we within CSI, within the entrepreneurship space as well, as I'm sure everyone on this call knows, talking about exit strategies and valuations and finance and investment and, building unicorns and all the rest of it. A huge part of an entrepreneur's journey is, of course, understanding the numbers and making sure that the money's there and, the finances aren't necessarily the obstacle that prevents the growth. Of course, finance isn't everything, but it's certainly a reality and a key that unlocks a lot of potential and realization of plans in terms of either scaling or growing or solving for employment opportunities, etc. So one of the key and critical areas we realize within CSI that's potentially not as well crafted, as well considered, etc., was how do we, because we certainly don't have an unlimited resource bucket, to just throw money at every entrepreneur that comes through, but how do we, instead of giving them fish, how do we teach them how to fish? And that means if you are looking for investment, and that investment can take different forms in terms of finance, how can you be best positioned as an entrepreneur to make sure that when you go out there at the point in time that you do need different financial investment, how are you going to be best positioned to do that? So that's where the Finance Readiness Program comes into play, where we work with select entrepreneurs, because again, the program is pretty intense. There's a huge team from the OCFO that works with these entrepreneurs through an extensive 8 to 9 month period of time, where you're looking at all aspects that investors like your panel, that you've gotten, as well as the audience members here, would want to look at in an entrepreneur's business. So everything from, yes, their management accounts, their financials, but also all of the other stuff as well, that an investor also wants to see, are these things being considered? Are they the way they should be? Are they in shape, etc.? And the beauty of it is, in terms of how we structure the program, is that we know that all entrepreneurs don't have this sorted. So the program really looks to identify entrepreneurs that we know are in a position, are almost ripe for the picking, working and identifying specific areas within their business that we know investors are looking for to understand, not necessarily to have perfect, because of course the investor needs to walk the journey with the entrepreneur, but certainly have a level of comfort to understand what those areas are, at what stage of readiness those areas are, and how we're going to look to fix that. And that's where the OCFO team, in terms of the expertise and skills, come in to kind of have these very key specific areas mapped out for each individual business, putting a plan together of how we best take that to the next level, or to a level that an investor would want to consider this business for investment, and putting those interventions in place. We then host what we call our Finance Readiness Roundtable, which is an exciting culmination event of the huge amount of work that's done before that. And that's really giving the investors opportunity to literally, pick, choose, and refuse which entrepreneurs they want, across different sectors, depending on what their mandate is. But more specifically, having an entrepreneur groomed, ready with their pitch deck and everything an investor is going to ask them prepared, and literally there for the investor to then say, well, this is what I want, and this is what I don't want. I think the beauty of it as well is, a lot of investors potentially take maybe 2 to 3 years to try and just find this entrepreneur and hopefully get, see that the entrepreneur has made good strides. We do this in less than a year and literally present them with a whole array of entrepreneurs to choose from as well. So it gets a lot of that pain work out the way, and really just getting the business of finance into the business as well. As you said, we've been running it for 5 years with OCFO. It's been going incredibly well. We've realized some fantastic investment in deals for entrepreneurs. We actually just concluded our 2021 cohort about a month or so ago, and talks are underway and things are really looking promising. So the program's going from strength to strength, and we've really, like I said, impacted and enabled entrepreneurs in a very real way when it comes to finance, when it comes to investment, and when it comes to really taking their business to the next level.
Well, Sean, yes, I can just add to that. It's amazing to see how the mindset of these entrepreneurs change, as well as helping some of the success stories of the entrepreneurs that got funding through this program as well. Sean, let's say I'm an entrepreneur and I'm in this audience now, and let's say I'm not potentially looking for funding. What other type of programs does Investec CSI offer for entrepreneurs?
Sure, I'm gonna say what is probably going to be considered very controversial, but money is not everything. It really, really isn't. I think you can throw money at something that's probably not going to solve the greater and the bigger issue necessarily. And we realize that and we appreciate that, but also understanding that understanding the finances and keeping a pulse on it is certainly going to take you a long way. But what we've also identified as a core and critical, avenue of support that's needed for entrepreneurs is, yes, we can solve for the money issue, and we can do that in a way that's sustainable, that makes sense, that's structured, and that's what the Finance Readiness Program provides. But it's also about understanding what opportunities lie in front of the entrepreneur that they're potentially not tapping into. So that's looking at opportunities in terms of how is your brand, how is your business, how is your product, how is your service, how are you received, how are you understood in the market, and knowing where you could potentially tap into opportunities, client streams, procurement opportunities, etc., that you possibly wouldn't even have thought of. And that's what the Market Readiness Program does. So it's not guaranteeing the entrepreneur that, in 6 months' time after you do our program, you are going to, grow your revenue by X amount, but it's certainly allowing you to understand, well, here's kind of drawing the curtain for you in a much wider space, in a much wider way, for you to understand the different doors that you could potentially knock on, that you potentially didn't even realize existed. And we can do that by getting you more market ready. So whether that's understanding, your brand strategy, whether that's understanding how do you show up within your sector, whether that's PR, whether that's, just leveraging different opportunities that you may not even have thought of, understanding your client base, your competition, etc. There's a whole myriad of different opportunities that, again, as I'm sure most entrepreneurs on the call attest for, you don't necessarily have the eye for, or haven't taken the time to actually realize what opportunities are in front of you. And this is so much more than just a marketing exercise. So guys, please, this is not about we build a fancy website or, we put a nice ribbon on top of it. It's really understanding the discipline around how do you actually understand what opportunities are available and how do you capitalize on that. So we're very excited with that program as well, because it just brings a whole different element and dynamic of entrepreneurial support to really enable entrepreneurs in a real way to grow their businesses. We've completed a pilot, which we learned a lot of lessons with, and COVID taught us very good lessons, launching a sort of market readiness. But I think that was a perfect testing ground to see, does this program actually have the speed and the impetus that we needed to have in a time like COVID? So I think that really, really gave us some learnings and insights that we're definitely looking to take forward. So we're really looking forward to the Market Readiness Program in terms of this year's launch as well.
Perhaps just in conclusion, I see as a comment as well for the audience, where can the entrepreneurs find out more about these programs from Investec side?
So as we were learning and growing with the programs, and we always take a very sort of cautious approach to these things, because you always want to, make sure that the impact is there before you kind of bang the big drum about it. But I think I can confidently say, I think with the Finance Readiness Program, with the partnership we've had at OCFO, we've really seen some incredible results in terms of what's gone in and what's come out of it at the end of the day. And we are looking to open up applications to a much broader audience, because previously what was how we used to focus our kind of initiatives is really just focus on our alumni base that we've had from different programs, which become part of our pipeline. But this year, in the next month or two, please just watch it on all social media channels that Investec has. OCFA will also be pushing it out there as well, because they've got some fantastic mediums. Lucille from their marketing department has been doing a superb and stellar job on that. They've got the new branding out. So we will be pushing out, call to action in terms of applications for finance readiness, applications for the Market Readiness Program. So we're really looking forward and hoping for, a good influx of applicants that we can select to take to the program. And as I said, we've got tangible outcomes and results from this. So we're really excited to take this to the broader entrepreneurial community that's out there. I do see there were a few more comments as well on the side here, if I can maybe briefly just from Robin London. Thanks for the insights. Yeah, I completely agree with 100%. The learning, trainings, and guidance support and mentorship is just invaluable for entrepreneurs. We've learned that lesson. We've seen that feedback as well. It's a lot more than just about the money as well. Matt Kluas, your systems run your business, your people run the systems, you lead the people. We like this, Leanne Tian, from Tian as well. Again, from your previous speakers, everyone seems to be agreeing very much with the panel, speaking about great stuff. Yeah, I guess I spoke to Mary Jane's question about how do we access the program. As I said, we run application call-outs at different points in time. And we also understand as well, I mean, the programs that OCFO run certainly have a level of expertise and a level of mature businesses, but we also understand, you know, the small SMEs and the startups out there are really huge key in terms of economy. So the township economy for us is a huge focus and space that we also play in as well with our startup school program. And this is a 12-week online program that really enables guys that are either thinking about the idea, so this is your startups in ideation phase, or even guys that have been in business for like 2 to 3 years and looking at scaling up. Our startup school program as well provides that level of support, training, thinking, mentorship, network, even prize funding to enable the businesses to actually move on to the next stage. And that's also been going brilliantly. Stuart Cohen is the head of and the honorary chairman of the Mr. Price Group and UCT's Graduate School of Business. He's also the partners that we work with on that. So we've done some incredible and exciting things as well with entrepreneurs, even in that early stage of startup. So yeah, some exciting things that are happening out there.
Sure. That's that for time. Sean, thank you so much for sharing the conference with me and your input. Yeah, over to you, Lo.
Sean, Donna,
so
thank you very much, gentlemen. Thanks for sharing what you're up to. Sean, always amazing to see a corporate investment bank like Investec stepping up and helping early stage entrepreneurs in different ways, whether it's market readiness or finance readiness. Really amazing to be working with you guys on making the entrepreneurial ecosystem a better place in South Africa.
Great. Thank you so much to everybody. And yeah, thank you so much to the OCFO team. You guys are doing incredible stuff in the space as well. So really excited to see how we build bigger and better from here as well. And thank you all for listening to me and also for hosting me as well. Have a good evening.
Thanks, Sean. Thanks, Donna. Appreciate it so much.
Thank you. Bye-bye.
Ayanda, I see you're already online with me. Can I ask you to step up? Guys,
Hello.
Hey, how are you?
Good, how are you?
Good, thanks. Guys, we thought we would ask one of the best fundraising experts and chartered accountants in our network to give us a couple of tips on capital raising and how to approach this fundraising process from a finance perspective. So we're going to give Ayanda the floor for the last couple of minutes as we see out this conference. Ayanda, great to have you, and over to you.
Thank you so much, Lo. Thanks, OCFO team. Just a quick introduction. I'm Ayanda. I'm one of the CAs that works with OCFO as a consultant, and I also run my own consulting business called Kwandiso Consulting. Firstly, I must thank all the speakers this evening because they have mentioned everything that I am going to be speaking about, and they've made my job so much easier. So thank you, everyone. It's been really insightful just listening to everyone speaking. So I'm going to jump straight into it. The first thing I'm going to mention is get your affairs in order. Tian spoke about it, getting your financial processes right, getting everything in order, because you need to be able to pull the trigger should a potential investor want to take the conversation further with you, right? But not just your financials. Know your market, know your product, know your competitors, know what you're talking about. Get everything in order. You don't want to be umming and oohing when an investor says, okay, let's take it to a DD phase, right? To do the due diligence. You want to be ready to pull the trigger. So get your affairs in order. Secondly, do your research. Research the potential investors that you want to engage. Research what kind of funding, what kind of deals that they engage in. Research the cost of each type of funding and whether your business and you have the appetite for that kind of funding. Look into other deals that they've potentially done and be able to have an informed discussion with them. It will be very awkward now if you get there, you present, and then they say, do you have any questions? And you say, please tell me about yourself. Thirdly, look further than now. Look further than the capital that you need to raise right now for a piece of equipment that you want to buy. Be able to tell the story of your short-term, medium-term, long-term goals, because getting into a relationship with an investor is often a long-term relationship, and you need to be able to know if you're speaking the same language and if you can understand each other. How can two people walk together unless they agree, right? Fourthly, be flexible. As Sean also mentioned, that fundraising can not only yield financial results, it can yield other things. We recently engaged with a potential investor that isn't so keen on writing checks, but is keen on plugging in startups into an ecosystem. So an ecosystem where you have access to financial accountants and lawyers and techies that you don't necessarily have to pay for. Now, that kind of fundraising doesn't necessarily result in a check that's written out or cash in the bank. It results in being able to have access to other opportunities, being able to focus on your core business because everything else can be outsourced to outsource CFO, for example. The fifth thing that I want to mention is optimizing your track record. What I've seen in the fund space, where funds will engage in fundraising or will start the fundraising round, they will, as they're fundraising, deploy a bit of capital into projects or funding other working capital engagements to be able to show a track record to potential investors, to be able to say, not only can we raise funds, we also know how to identify good deals. We also know how to identify gaps and how to deploy this capital. And this goes hand in hand with fundraising, being able to show a success story, being able to show that you have a full package in terms of your offering. It's not just about fundraising, but it's also about deploying the funds. It goes a long way with your fundraising process. And then lastly, what I want to say is know your story. Know what you're talking about. Do not waver. Do not be swayed. Know exactly who you are, what you stand for, what you will and will not accept. Know who your customers are. Know who you're targeting. Know who your competitors are. Even know if you're competing on price or you're competing on quality or you're competing on turnaround times. Know those things. Because if you're able to sell the story and you believe the story, then it makes things that much easier, right? So lastly, just thank you to the OCFO team for organizing an amazing FundRaise conference. And thank you for the opportunity to share my 5 tips for fundraising.
Sure, Ayanda, thank you very much for closing us out on such a high note. I think you really kind of summarized everything that has been said here by entrepreneurs, by investors. Really good inputs. Really appreciate you being here with us so late. As you guys can see by the lighting situation here on this side, it's nice and late in South Africa right now. I think everyone can check out knowing that they have gotten some really good input on their investment and fundraising journeys. We hope to see all of you guys raise incredible rounds of finance as we move forward. And obviously, if there is anything that is needed on the finance side of things, so the finance and accounting and reporting side of things, and on that journey, Team Outsource CFO will be here to support you guys on building your ventures and scaling them up and raising the different rounds of capital. We love having you here. So great to see so many of you turn up for this time slot, and so happy to be able to share thoughts on this platform with so many incredible entrepreneurs and investors and professionals. Thanks for being with us. We will see you for the next one in 3 months' time around June. It is Scale Up Conference, our next very big event on the calendar for the year. Keep an eye out for the in-between webinars and events we host with other partners, but that's the next big one. We'll see you guys there. Have a great evening. Speak soon.